Hello, today we're going to be talking about financial markets. This is an area that a lot of people have said has been a little confusing, so I thought it was worth putting a bit more detail into it. There are no models in this, there are no real difficult things to do other than just learning the key terms and learning how to link them, which is what we're going to do today. We're going to look at three questions today. One is explain two roles of financial markets. The other is explain two reasons or examine two reasons for market failure to occur in the financial market industry. And thirdly, should the government intervene and give bailouts to banks in these situations? Okay, so they're three questions that we're going to give ourselves today. Role of financial markets, we've got five of them. Facilitating saving and lending. Now, all of this unit, if you want to boil it down to anything, is about over lending. So lending is key to everything. If you get that, you essentially get the whole of this unit. So if you're going to talk about those two, if you want to use those together as one. So banks, they encourage people to save, they then take those savings and they lend to businesses who invest. So a simple model there. Third one, to facilitate exchange of goods and services. I don't think that's one that I would talk about myself, but you do that through, say, payment systems and ATMs. The one that I would talk about is providing forward markets in currencies and commodities. So, for example, airlines might want to fix their future oil price, so they create a contract with the bank. If the oil price rises, the airline can continue to buy their oil at the original price and they will receive compensation from the bank, and the other way around. So if it falls, then obviously it would have been good for the airline. However, they don't see that fall in the price. The company then pays a fee to arrange that, and obviously the bank is then taking the risk away from the firm. And if the bank has enough of these commodities and enough of different currencies, they should level each other out, and therefore it therefore reduces the volatility that businesses will experience, allowing investment. So again, that boosts to spending. Finally, a market for equities. Equities are essentially stocks and shares. And if I'm a company, I can raise money on the stock market by issuing stocks. People through those stock markets will buy them, and this allows me to have higher amounts of money for investment. Again, shifting AD, shifting LRAS. Right, pause the video now and do the following exercise, and the answers are on the next page. Come back to me in a couple of minutes when you've done that. Okay, the answers are there. We'll be using those later. Just check that you've got those right. Right, market failure in the financial sector. We've got some new words here, and you need to learn these words and their definitions and examples of them and how they link, because they all link together. The first two, 1 and 2, are both reasons. So this is a reason for market failure. Reason 1, reason 2. So asymmetric information. Someone has more information than another. In this case, it's often the bank has less information than the borrower. So if I go to the bank and I want to buy a house, I need a mortgage. I go to the bank, I say, can I have a mortgage, please? They might want to check whether I am suitable to take a mortgage. To do that, they might check my income, they might check my job, they might check my bank statements, but they may not know that much about me. I might have a job, I might have an income, but it may not be stable. They may not know that. In many cases, the banks didn't get that information because they didn't check. So income verification, verifying someone's income, is really important. A lot of banks didn't actually know who they were lending to. They just lent to everyone. So that is a real issue. One of the reasons why they might have done that may be because they didn't know, but it also might be because they didn't care. If you have moral hazard, then you may not need to know what background income or background checks you need to give to certain risky borrowers, because you know that if it goes wrong and those people cannot pay their debts back to you, then if you go bankrupt, it's likely that the government is going to what we call bail you out. It's likely to recapitalize the bank. It will inject money into the bank to prevent you going bankrupt because you're too big to fail. If you fail, then lending in the economy is going to fall, economic growth is going to fall, and therefore the government does not want to see that happen. So moral hazard, therefore, is probably, I would say, more important than asymmetric information. I think that banks can probably find the information if they want. Perhaps they weren't particularly motivated to do so. All of this creates over-lending. And essentially, when banks lend, they will probably start out by lending to less risky individuals. And once you've exhausted all of the good firms to lend to and all the good consumers, when you want to continue lending, the people you get to are the people who have low incomes, who have bad business models. And so that's really where the overlending is. And that overlending in the US before 2008 was in the subprime mortgage market. Subprime mortgages are mortgages to those who have low incomes, who have risky jobs. Okay, before we get there though, that overlending will fuel market bubbles. When we have more lending from banks, and we can see this here, between 2000 and 2007, UK banks created £1 trillion. A lot of that going to and 32% to the financial sector, lots of it to property. You boost the demand for stocks and shares, for example, and houses, assets. So overlending in the housing market results in demand going up for houses, if this is the price of houses. Now, a lot of these people then who are buying houses are buying it on credit. As the price rises, this then brings other people into the market who start to expect that prices are going to rise further. And when people expect the price to rise further, then you're going to get an even bigger increase in demand, and the price goes up and up. That is a price bubble. P3 is above the price that any normal homeowner could pay for a house, but it's all been driven by speculation. What happens then when we have market bubbles driven by overlending and speculation? Well, as soon as the price falls, because I've borrowed the money, therefore I'm very scared of losing it. I will go bankrupt if I lose money on this asset. So it means that people are very, very quick to sell their assets as soon as the price goes down. Equally, many of these people who took on extra loans were buying second houses or third houses. And I'm not going to sell my own house if I see house prices going down. That would make me homeless. But I'm certainly going to maybe try and sell my second house and my third house. And the second and third houses that people bought often were the overlending. And so it just simply means that if you overlend and inflate asset prices, they are very much more likely to suddenly fall. You can see a sudden fall in asset prices. And if you've borrowed to be able to pay for those assets and the assets fall in price, you may not be able to pay back your loan. And so what we're going to see is defaults. Borrowers are unable to pay back their loans to the banks. And therefore banks then lose money because they cannot pull back the loans that they've lent out. Therefore, banks have a liquidity problem. They start to lose money. And if they lose enough, the market bubble, generally that's where it happens. So we have a chain of events here. We have overlending from asymmetric information and moral hazard, creating a market bubble, the market bubble then bursting, asset prices dropping, and banks getting into real difficulty as they cannot recall all the loans that they gave out, all those subprime loans. Suddenly, you can't get them back. So banks go bankrupt or have the possibility of going bankrupt. And to prevent that from happening, there's one of two things that could happen. You could say that savers are the third party. You could say that if banks go bankrupt, savers lose their money. So that could be the negative externality. So the third party, the savers weren't involved in buying and selling houses, but they're the ones who have to pay for it when the market crashes. If you did that, though, the whole economy would crash and no one would have any money at all. So in order to avoid that, the taxpayer, the bank, will give a bailout. And a bailout is simply just injecting money into a bank through possibly concessionary terms loans, or possibly even buying the bank itself. And that costs the taxpayer money. That money obviously is an opportunity cost, and that is the third party. You can then say that there's been market failure in the financial industry as we have made too many loans to consumers. You could then evaluate that and say, well, the extent to which you are going to have a bailout depends on the number of banks that fail. And if it's just one bank, then it might not be too much. If multiple banks fail, as they could do, if one bank fails and then we lose confidence is key here, and confidence falls and then other asset prices fall, then other banks could go as well. And before 2008, AIG, an insurer, insured all the investment banks. If AIG goes bankrupt, it can't insure the other banks, and they might therefore collapse as well. If they collapse as well, the magnitude of the bailout is greater, and that therefore is eval. Market rigging, just learn that definition. The exact ins and outs of it, I don't think you have to go into in the exam. Right, so if we wanted to give some example questions, we could do it like this. Two functions of financial markets. Pick two, but just make sure you're using technical terms. There's an awful lot of waffle going on the last time we did this in a paper. So I would use saving and lending and explain how that works together. And then I would use forward markets, because that is so much easier to there's more to explain there, and you're likely to get 2 marks for both. So that's a section A question. Discuss the reasons for market failure in the financial sector. So you would want to define a negative externality straight away. So you're going to use your negative externality. So it sounds a little micro, doesn't it? But that's still relevant. In a paper 2, you're not going to draw a negative externality diagram because that's a micro diagram, although you might do it in paper 3. Remember, in the 2022 exam, this is not in paper 3, so you're not going to be drawing a negative externality diagram in that exam. I would then pick 2 points. I would pick possibly asymmetric information and talk about what the asymmetric information is and how that leads to overlending and therefore market failure. And we probably go through what we just did before, possibly talk about bubbles, possibly talk about asset prices falling and therefore banks running out of cash, resulting in a need for bailouts. And moral hazard, define it, and then explain how banks take on more risky behavior because of it. So you could refer to each of those there. The size of the market failure, you could then, the eval, you could probably find some eval from the text. There might be something about asymmetric information. The eval could be previous bailouts. So if there has been a previous bailout, then there's going to be more moral hazard. So it depends on the magnitude of the moral hazard, depends on previous actions by the government. For example, you could also use systemic risk. How big how big will the bailout have to be? It depends on how many people go bankrupt. That all depends on confidence, and so what else is happening at the same time. Finally, should we intervene? If you want to look at whether we should intervene or not, well, all you have to do is to look at what the financial sector does. And the financial sector, what we said it did was this: it shifts AD to the right. If the financial sector gets into problems, then AD is going to shift to the left as lending dries up. So that's your argument, really, that if you have a default in the financial system, you're going to see a big AD shift to the left. The government bailout could help that, and you're going to be talking about how that's going to result in more lending, and then I'd use AD to help you and then show how it's going to boost economic growth. But by doing that, you are actually creating a huge moral hazard, which is going to encourage risk